Fixed income is usually the rather staid, some might say boring aspect of investing in a globally diversified portfolio of index funds. Bond funds, though, play a critical role in determining the most risk-appropriate portfolio for each individual IFA investor. Along these lines, we're fortunate to have with us today Doug Longo, a Dimensional Fund Advisors Vice President and Co-Head of Product Specialists. He's a veteran fixed income expert and someone who's uniquely qualified to discuss the inner workings of bond funds, particularly those recommended by IFA's investment committee. Hi, Doug. Thanks for taking the time to discuss what on the surface might seem like a fairly boring topic.
Thank you. And I appreciate you having me here today. And although it may be a boring topic, I work with bonds all day long, every day.
Perhaps we can start out with a simple explanation of just what bonds are. I think a lot of the lack of interest investors have with bond funds is simply due to the fact these aren't always the most well understood investment vehicles. So let's start with the basics. A bond is essentially an IOU issued by a government agency or corporation, correct?
That's right. So the way I think about bonds is they're basically loans. So you can have a company, a state or government, they issue a bond to raise money. Those funds could be used to issue or issued to fund something such as expansion programs, to build schools or hospitals. That bond issuer who's taking the loan, they agree to pay to their investors, generally a periodic fixed income payment. That's why we call it fixed income. So hence that term. And then they want to repay the loan when that bond matures or the principal of that.
Okay, so there's two aspects to a bond, right? The principal, and they call it coupon and interest and all that stuff, right?
That's right. So the principal is generally going to be how much you're lending that particular borrower. That'll be paid at the maturity. And then from the time that bond is issued until it matures, you get paid a coupon payment, and that coupon is going to be the interest on the amount of funds that you lend to that issuer. And coupons could either be paid twice a year or once a year. It really just depends on the individual bond itself.
Sure. And also government agencies, for example, will, the more risky, can we say, of an issue, the higher the interest rate or the coupon rate they'll issue, correct?
Yeah, and I kind of like to think about this in terms of just personal credit score. So each issuer of a bond is just like a person. Each issuer has a credit score, and the worse that credit score is, the higher the yield is or coupon that issuer has to pay on the bond. Government bonds tend to be the least riskiest of all bonds out there, so they pay the less interest on those bonds. So as a lender to the government, you generally don't get as much interest from that bond, whereas corporates tend to be a little bit more riskier, and they have lower credit scores. And as a result, you get higher interest payments from corporate bonds.
Sure. But a lot of people like to mix corporates with less risky government bonds. Is there more risk involved in just rather than staying with just straight treasuries or something like that?
So when you mix different issuers, you get more diversification. And that's really key, is that anytime you have a portfolio, whether it's in bonds or in stocks, you want to have many different types of issuers in different sectors. Sectors could be governments or corporates. And that, as a result, is going to reduce some of the volatility of your overall portfolio.
Okay. And then treasuries are fully supported by the U.S. Treasury, correct? And corporates are supported by the company that issues them.
That's absolutely correct. So the U.S. Treasury bonds, for instance, it's about a $24 trillion market. They're backed by the full faith and credit of the U.S. Treasury. The U.S. Treasury has a unique situation where it could always print more money to pay for its bonds. So as a result, they tend to be the least riskiest of all the bonds out there. In fact, we call U.S. Treasuries the risk-free rate. So it's basically taking no risk to borrow for the U.S. Treasury. And corporate issuers, their bonds are slightly riskier relative to the Treasury. And again, as a result, you get higher interest rates for corporate bonds.
Sure. And since they issue a coupon interest payments, on sometimes a monthly basis. You have to be careful about what type of accounts you hold these in terms of taxation, correct?
That's right. So US Treasury bonds, for example, they're taxable on the federal level. So you'll pay federal income tax on the interest paid from those coupons. So if you're an ultra high net worth individual in a high tax bracket, you may want to hold those in your tax deferred accounts. There are other types of bonds out there, municipal bonds, which the income is generally.
Could you go talk a little bit about municipal bonds and explain
Sure.
exactly what those are?
Yeah, absolutely. So far we've been speaking about mostly U.S. Treasuries. So those are issued by the U.S. government. And then you have municipalities. So a municipality could be a school district, it could be a state or a local government, it could be a hospital. And when they issue those bonds, the holders of those bonds generally don't pay federal income tax on the interest earned from those bonds. Additionally, if you buy a municipal bond issued in your state, you generally don't have to pay both state and federal income tax on the interest. And the idea there is really to incentivize people to invest in municipalities, because municipalities will generally build something that's for the greater good. So it might be a hospital, could be a road or a school or something along those lines.
That all sounds great, but there is added risk versus investing in treasuries, correct?
Absolutely. As I was saying earlier, the US Treasury, you can think about it what we call the risk-free rate. So anything that you're investing in other than US Treasuries is typically going to have more risk. And because of that, when we set interest rates on securities like corporate bonds or municipal bonds, we're going to try to make sure that we get additional interest over the risk-free rate or US Treasuries to take that additional risk in portfolios.
Sure. And that has to be a major consideration for equity heavy portfolios, don't you think?
Absolutely. So you want to make sure that your bonds complement your equity so that you do have diversification in your portfolios.
Okay. And then corporates, of course, there's companies in the US, there's companies in emerging markets, there's companies in Europe and all over the place. Could you talk about a little bit about the risk involved in investing in corporate bonds?
Absolutely. So, corporates are usually issued by companies. They offer a premium over government bonds, again, because of that risk that's additional relative to governments. They may take those proceeds and go out and build a new factory or additional infrastructure at their company. Unfortunately, corporations, unlike governments, they don't have taxing authority. So governments, municipalities, they could increase taxes, whether it's property tax, sales tax, income tax, and use that revenue to service their bond debts. Whereas corporations, they're really constrained to the revenue that they generate. So if it's a corporation that isn't generating a lot of revenue, there's more risk in terms of servicing their debt. And because of that, we expect higher returns as an investor in corporate bonds.
Okay. And especially those internationally, correct?
Absolutely. When you invest in international bonds, the U.S. is what we call a developed country. Some international bonds could be non-developed or emerging markets. It really runs the entire gamut in terms of credit quality in a global context.
Okay. And why would you want to take on more risk by buying, especially corporate bonds from companies headquartered outside the U.S.?
There are a couple of different reasons. One is you may be a heavily weighted equity investor, so that marginal risk from corporate bonds is relatively small, but you can get higher interest rate relative to a government bond. So it may be worth it. The additional volatility from that corporate bonds de minimis relative to the equities. Also, what we find is when we look at interest rates globally, they all don't move in lockstep. So interest rates may increase in the US, they may not increase in the UK or in Australia or Canada. So by having bonds in many different economies around the world, you can also smoothen out your returns and reduce some of the volatility.
So diversification in bonds is just as important as in equities.
Absolutely. Diversification is always going to be your friend in any context of investing.
Okay. Thank you very much for your time today, Doug.
My pleasure. Thank you for having me.